Welcome and thanks for joining this talk on evaluating private fund performance. Over the next few minutes, we will unpack the metrics and benchmarks that investors use to make informed allocation decisions, explain common measurement pitfalls, and show how complementary tools together reveal the real economic return behind headline numbers. Private fund cash flows are inherently irregular, with unpredictable capital calls and lumpy distributions that make direct IRR comparisons misleading. The chart illustrates how timing differences can exaggerate quick exits and undervalue long holds. So investors need complementary measures like MOIC, TVPI, and PME to neutralize timing distortions and reveal true economic profit across different liquidity profiles. IRR is the industry's common language because it compresses cash flows into a single rate. But it has important limitations. Its reinvestment assumption can overstate returns when early exits occur, and it can mask locked value. Pairing IRR with multiples and time-weighted alternatives creates a balanced evaluation that reduces overstatement risk and supports more accurate cross-fund ranking. MOIC and TVPI anchor IRR in absolute dollars and expose value that remains locked inside portfolio companies. MOIC shows raw value creation relative to invested capital, while TVPI adds unrealized residuals to distributions to reflect total value. Together, they translate percentage returns into tangible dollars and reveal how much value is still waiting to be realized. DPI and RVPI track realize proof versus future promise. DPI measures cash actually returned to limited partners and proves liquidity capability, while RVPI quantifies unrealized holdings and the upside that remains. Watching their progression over a fund lifecycle helps LPs judge how much performance is proven today and how much is still contingent on future exits. PME benchmarks private fund cash flows against a replicated public index to answer the what-if question of buying the public market instead. Variants adjust for timing and isolate alpha, with long nickels comparing IRRs for timing-adjusted performance and direct alpha expressing market relative excess return in percentage terms, turning opaque private returns into transparent, comparable metrics. A robust benchmarking framework groups funds by launch year and strategy, then ranks them into quartiles to control for macro cycles and peer differences. Top quartile persistence can signal skill, while median comparisons reveal relative value, but we must acknowledge survivorship and self-reporting biases, so signals are interpreted cautiously and combined with other evidence for reliability. To get robust evidence, we triangulate core metrics: IRR for speed of capital growth, TVPI for total realized and unrealized value, and DPI for cash reality. Cross-checking those signals against PME and vintage quartiles confirms whether alpha holds up versus public markets and peers. This multi-angle approach helps ensure capital allocation rests on proven edge rather than on headline numbers alone. Private fund targets often assume high IRRs and multiples, especially in venture, yet public indices have delivered roughly 12 to 13% in recent years. That gap creates a benchmark challenge, because failing to beat PME plus inflation risks LP confidence and future commitments. Discipline in measurement and transparent reporting are therefore mission-critical to sustain trust and secure future capital.